Hey everybody, welcome to this free edition of our Trader User Group for the trading week ending October 14th, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is clearly a costly roller coaster ride for many folks. A lot of records are continuing to be set each and every week. Let's go take a look at what happened this past week and then kind of where I see the market shaping up and what we're looking at for Q4. If we look at the or the index performance for the U.S., you can see the Dow was the only one that managed to finish in the green, up a little over 1%. Everybody else had really had an ugly week. Nasdaq really down hard, 3.11%. Year to date, everybody is in bear market territory with the exception of the Dow, just barely hanging on in very strong correction territory. You can see the PE ratio. The trailing PE ratio is sitting at 17.85. Forward is 16.37. Dividend yield coming in at a robust 1.80%. Treasury, very strong, even more robust, over 4% at 4.01, is higher by 221 basis points over the dividend yield. The earnings yield for the S&P is coming in at a strong 6.34%, but I suspect the earnings per share is going to continue to come down as far as the estimates go as we move into the next year. S&P yield over the 10-year Treasury at 2.33%. The real yield is still negative, just slightly under 2%. So inflation is still up very high. You can see the VIX, even when it finished the prior week at 31.36, it finished up this week 32.02. And you can see the best and worst performers for the sectors this past week in the U.S. Staples, typically a risk-off sector, finished the best. Worst being discretionary at 3.83. And then the annual sector performance, obviously energy's led right out of the gate this year, and they're still up very strong, almost 50% for the year. Communication services bringing up the rear at 37.80. Well, like I said, we had a rip your shirt off move on Thursday. We had the CPI data print coming out. The markets fell right after, as you would expect, a really ugly CPI data print. And then it moved up 5.5% off that down move. That was the biggest intraday move that we've seen really in over a decade. If you take away the March 25th, 2020 COVID move, take that out. Very strong movement. We're getting the IMF is basically coming out and reducing its forecast for global economic growth in 22 and 23. I mean, the message is clear just about with every central bank and IMF expecting a slowdown going into 2023, right? Now, this past week here in the U.S., the Labor Department came out with PPI data. It actually rose 40 basis points in September, double the consensus expectation for around a 20 basis point increase. Year-over-year basis, prices rose about 8.5%. So we're still, PPI is still very strong. And Thursday's CPI data showed that inflation is still here, with core actually moving up 6.6% year-over-year. That was more than expected. And that's what got the market selling off. And then we had that huge rip your shirt off rally to finish out the day in a really unusual wide swing. Typically, folks, when you get wide swings like this in the market, it shows that we're nearing at the beginning of the end of a bottom forming. And that is normal. If you look back on all the bear markets and then, where is the bottom? Everybody's trying to find the bottom, and it's usually almost impossible to do. But one symptom of a bottom is you get very wide swings where you have a short squeeze, markets move up very strong, and then they roll right back over again. Okay. And of course, if we look at over across the pond, and let's focus on the Europe first, you can see basically in the green with everybody but the FTSE, which is the London index, right? They kind of screwed up. The Euro stocks, it's not up 19% for the week. It was 1.9%. Year to date, everybody's still solid in the red. But in the UK, their economy unexpectedly shrank 30 basis points from August into September. So we're seeing a little bit of a continued fallout also from the government in Great Britain when they proposed their tax reduction plan. And then they quickly had to change that with a lack of liquidity in the gilt market, which is their bond market. They really kind of screwed up. So they're kind of still dealing with that mess over there. Meanwhile, the Eurozone, their industrial production climbed about 1.5% over August. So that is good. However, the German government slashed their economic forecast for the next 2 years, blaming, of course, price increases, which is inflation, energy shortfalls, and supply chain disruptions, caused by Russia's invasion in Ukraine. A whole host of reasons. But net, all across the US and the Eurozone, the economy is slowing down. Okay. Now, if we look over in the Asian markets, you can see basically, still the U.S. news was a major driver in Japan. You can see here the Nikkei about flat for the week, down year to date. China is up a little bit. They're coming off of their week-long National Day holiday, and then Hang Seng down really ugly. But looking at Japan in a minute, they had some consumer confidence surveys which fell for the second straight month. And the currency market, the yen, is still very weak against the US dollar. In China, sorry. Again, like Japan, the People's Bank of China is focusing on supporting infrastructure spending, construction, and things like that. So they're putting money back into their economy, just like Japan. So we're seeing a lot of that. Meanwhile, the Communist Party is hosting their twice a decade gathering of all their political elite. And President Xi is probably going to be nominated for a third successive term. So we'll see how that all plays itself out. And like the yen in Japan, the yuan has lost, double digits, over 10% against the US dollar this year. So that's the biggest loss that they've had in the yuan against the US since 1994. So one other key note, consumers in China are still spending less and less. Excuse me. The tourism board in China reported that. Hang on just 1 second, guys. Let me do something here for just one quick second. Sorry, guys, I had something stuck in my throat. But as I said, China's coming off a week-long National Day holiday, but it should be called National Week. They take the week off. I wish we had a week off in our markets. But their tourism board reported that the consumption for consumers during that week, because all consumers are traveling and spending, actually fell 26% from last year. So there is a slowing down of the economy everywhere. Okay, everywhere. So just kind of keep that in the back of your minds as I shift the screen over, and I'm going to show you the E-mini S&P 500 futures. Let me just get this over here. And what I'm going to do here is just kind of show you what I'm looking at and how I see things starting to shape up as we go into Q4 of this year. So as we look at this, and let me just get this back on the screen here for you. Let's get this right here. Get this back up. Bear with me 1 minute. There we go. Okay, so you guys should be seeing the S&P 500 E-mini futures right now. And this is a daily chart. And let me I'm still adjusting a couple of things on my screen here. Apologize. But what you can see here on this screen, my targeted rate was anywhere from 3,500 to 3,400 roughly. And you could see we came right down and hit 3,502 on August 13th. Okay, that's the 2022 low price. Do I think we'll go lower? Yes, but not right now. I think we're going to have a little bit of a time where we find some consolidation. I think the markets will be surprised pleasantly that the growth rates, although the bar has been lowered dramatically here in Q3 earnings, and we had the banks kick off on Friday, and it was kind of a mixed bag, but essentially the bank stocks were up because the bar is so low for earnings. I think earnings will beat expectations, and it'll give us a little bit of a lift going into November and December, but I think the ugliness is going to return. Okay. So have the lows been made? Well, not necessarily. For 2022, possibly, but I think we're going lower. But for 2022, I think we're forming the beginning of the end of the low for this year. Okay. And you could see here on this chart what I'm talking about. Now, I'm going to switch the screen a little bit. Let me get this other chart up here for you guys. And I've shown you this before. You can see here this downsloping trend line where we've hit the trend line, and then we come down to this 200-week moving average, which is also a place where markets tend to stop. Not a 200-day, but a 200-week moving average. This was my target range right here. You can see this shaded zone, and if you go back over to the left, right before the pandemic hit, COVID hit, in early February of 2020, we've come down and we've pretty much just about given up 50% of our gains, or coming back into the price level of the pre-pandemic. So all of these gains right here have pretty much been given up. And all these gains, as an FYI, were made with $4 trillion in stimulus thrown on the balance sheet. So this is a natural place for us to find a lot of support, which I think we're going to find as we kind of consolidate around here and then move up slightly for Q3. Okay. Q3 earnings as they come out. Now, we got another big event coming up on November the 2nd, which is the Fed funds policy, FOMC policy update. And we're going to get Boom Boom Powell. Boom Boom Powell is going to come out, and he's essentially, the odds favor now almost assured with that strong CPI number with core coming in at 6.6% of doing a 75 basis point rate hike. So I see that as a given. December is going to be a question mark, but I believe they're going to do a 50 basis point in December. So that would give us a Fed funds rate by the end of the year about 4.5%. And I think after that, they'll probably take it up in January, another 25 basis points, and then maybe do a pause. The market's on that pause. It's not a Fed pivot, but it's a market pause. I think we're going to have a strong move in the index. Okay. Now, a lot of it's going to depend, because remember, in January, we're going to be going into Q4 earnings, and we'll get a final read on 2022. I'm looking for a pretty serious pullback in the markets as all of these interest rate hikes work their way through the economy. There is a big lag in this process, and they will start to show up towards the middle of end of Q1 into Q2, and I think that is going to move the markets even lower. Members, I'll go through that with you guys this Sunday evening. That's kind of what I'm looking at here. And of course, if we look at the Nasdaq, you can see here on the Nasdaq, and we came right down to the upper boundary of my target. Okay, and I've had this target on for many months now. And if we look at Nasdaq, let me just find it on here. We've come down and we've hit my target. Okay, we've hit right in here on this target. We hit a low of 10,484 on the 13th. Okay, and we're down about 37.46%. So again, I think we're going to get a little bit of a movement up, and then you're going to see on the Russell, same thing with the Russell. We came down to my target down here on this area here, down in this area, and we're just kind of, we have not made new lows in the Russell. We did in Nasdaq, we did in the S&P, but not in the Russell. My target for the Russell is actually a little bit lower, down around 1570. That was my target in the Russell. And then, of course, if we look at the Dow, which is kind of doing the best of all our U.S. indexes, you can see here we hit my target here as well. Okay, it was down a little bit over 21.9%, but we hit the low in the Dow back on October the 3rd. So the lows in the Dow beginning of October, but the lows in the S&P and the Nasdaq were made this past week. Okay, if we come down here and let's just focus right now on the VIX, you can see the VIX finished at a robust 3202. We're staying up at this level. I've made a lot of comments with our members. I've talked to a lot of buddies also on comments with the that are hedge fund folks that are running hedge funds that understand volatility. And you can see that once you get up at this level up here, and this covers all of 2022, the VIX just refuses to go higher. And I know a lot of traders are expecting a capitulation in the VIX, but as you guys have heard me say all year long, I'm not seeing that this time. I'm seeing a slow, orderly move lower, a revaluation with rising interest rates, and then the Feds are trying to drain liquidity out of the balance sheet by cutting it. And I think that is what's going to cause massive problems for the markets. That's kind of how I see the markets really coming undone with that happening to price action. So anyway, the VIX is still very high, and we're going to watch how it comes through. Also, if we look at the 10-year note, 10-year Treasury, you can see here it's right on my target. We actually made a new high, and I think it's going to go higher. Okay, we're hitting my target right here, time and price, sitting right at my target was right around 4.03, 4.04. We hit 4.03, right on target. You can see the Elliott wave count is suggesting that we can move up to 5%. Okay, now that's not now. That's probably sometime in Q1 to Q2 of next year. And it's going to be a big tell as far as what the Feds do in November. Are they going to capitulate and do a pause? Or are they going to be more aggressive or as aggressive as they are now through Q1 of next year? That's going to be a big tell on where it positions the markets. So we got to watch this very closely. And of course, if we look at the bond market, down hard on Friday, right? This is the daily chart, but let me go back to a weekly chart of the bonds, okay? And if we look at a weekly chart of the bonds starting right over here, back in April of 2020, the bond market has capitulated. It has just given everything up. It's just rolled over. It's been very rare that we've seen the bond market and the equity market going at the same pace at the same time. Bonds are down dramatically in 2022 as the equity markets are. So those traditional 60-40 portfolios that hold 60% equity, 40% bonds have cratered this year. An unusual situation, but that's what's happened. I do believe bonds are going to have their heyday and moving back up, but just not near term. Okay. You can see here where we made a new low in bonds on Friday. I haven't updated my chart, but there we are right there. We're coming right down to my target, as I said, was around 121.31. So it's performing as expected. Okay. Now, if we come down here and we look at currencies, let's look at the US dollar. Very strong day on Friday, right? The dollar is probably going to move back up here and then roll right back over again. So I'm looking for going long the euro, just not yet. Because if we look at the euro, remember the dollar does not move alone. It moves based on a basket of other currencies, primarily the euro, yen, and pound. Okay, the euro is about 58% of the dollar index movement. The yen is almost 14%, and the pound's about 12%. So if we look at the euro and just kind of see where the euro's been going, you can see here it's down to 97.6 cents to the dollar, down in this area here. Cannot get over the 50 EMA. As I've told our members, as soon as we climb the 50 EMA, find support and start moving up, that's the signal to go long the euro. Currencies tend to trend. So that is what I want to play. And then the British pound, actually in their flash crash, came down to $1.03, 1.0392 to the US dollar, and then it bounced up. But unless or until it gets over the 50 EMA, same thing, right? Of course, if we look at metals, we look at gold. I am not a bullish player in gold just yet. My target for gold was down around 1605. We came down to 1622. I think we're going to come back down and challenge this area, and that'll kind of be what I'm looking at for a target in gold. Then I think things will change. As I told our members, this is a supply side type of inflationary environment, not a demand side. And typically when you get a supply side type of inflationary environment, gold tends to underperform. And then toss on top of it a very strong dollar, and that just pushes gold to the downside. And silver's the same, okay? If we look at silver, it's coming back down. It cannot hold it up. My target for silver is all the way down here around 16.6. So I see these things as really impacting the precious metals market. There will be a great time to be long the euro and precious metals, just not now. Look at oil. Well, members, we have our own way of trading oil. It works out fairly well. But oil, I think, is going to hover somewhere in the mid 70s to mid 80s, maybe 90 for a while, and then it's going to settle back in. All right, everybody, that's a really quick update on where the markets are. So just round this out, net net. I think we're in the beginning of the end of finding a bottom here in 2022. We could go a little bit lower. My downside range was 34 to 3,500. We had 3,502, 3,503. So we're near my range. I think we're going to get a little bit of a surprise in Q3 earnings because the bar has been lowered so much. We'll probably move neutral to sideways up. Of course, all this can change based on what the Fed say on November 2nd. Then I think we're going to get a run. And it's going to be kind of a fool's gold because in Q1, Q2, we're going to get another rollover and we'll take these lows out. Members, I'll review with you what that's going to look like in our weekly market watch Sunday evening. Have a great weekend, everybody. Enjoy football for you football fans out there or baseball. I will see you members Sunday evening for our weekly market watch. Take care, folks. Ciao now.